Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the economic wildcards that could drive mortgage rates lower this spring. Before we dive in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
Madam President, paper, rock, scissors.
Labor over inflation.
Labor over inflation. And, this is Friday morning. And, Thursday morning, I always joke around when the 10-year yield gets around 4%. And I was playing the video of Captain America holding Thanos' hand from coming down. And I'm trying to protect the 4% 10-year yield, which I'm really about to say it's on the verge of breaking. But it's Friday morning, and we had a really hot inflation print, like super hot inflation print. And it's going to be so hot that the PCE inflation data is going to have 3 or 3.1% year over year. And that's what the Fed really revolves around, the goods pricings of PCE inflation, more than the true inflation data that a lot of people are talking about that are showing inflation around with a one handle. But 10-year yield had already broken under 4% and just went up a smidge right after the report and came back down. So I think the question is now going out for the rest of this year. Obviously, this isn't like 2024 where the Fed cut rates and rates just shot back up. So obviously by now with mortgage spreads and everything, we don't have to worry about, rates shooting up to 7% or something like that, unless something crazy happens. But what are the wild cards now? Now that we're going into March, right? Here it is, right? And it's been such a long time that we've had mortgage rates stable, not much is going, and they're on the low end, So what can be the positive and negative wild cards for mortgage rates going out for the rest of this year, considering everything that we have now as a backdrop?
I think this is a great discussion because people are trying to figure out, with all the things that have shifted, what are the things that we should, what can they look at and go, yes, this is going to have this result. So for instance, right, that inflation report, would you have expected it to have more of a result on rates?
Technically speaking, the 10-year yield broke a key level. And where we always say there are no bond vigilantes. By the way, to the gentleman who's listening who says that nobody's going to buy the 10-year yield at 5% because America is a broke country, I suggest you go look at a 5-year chart of the 10-year yield. And as Matt Damon said once in a movie, how do you like them apples? There's a lot of noise right now on the economy. Private credit is, breaking supposedly, and AI, layoffs, Jack Dorsey had another over bloated company and he had to lay off 40% of the people. Stocks are selling off, so there's a lot of noise and kind of the old school thinking, when stocks sell off, money goes into bonds. Money's going into the bonds near 4% now for that. So there's obviously an ample amount of demand for our treasuries. But we're almost, I think we got to 397. By the time Monday happens, this might be over 4% again, but we're almost at the bottom of the 10-year yield range. That 380 line is the Hodor line. So we get to bring Hodor back. Am I saying it right, Sarah?
It's hold the door, so it's Hodor. It's not Hordor.
Yeah, right?
I think it's where you put the R is really important in this one.
Hodor. There we go.
Hodor.
In any case, what can be the positive rate story for housing going out for the rest of the year? Is that, hypothetically speaking, my line in the sand is 5.75%, 380 on the 10-year yield. Mortgage spreads, are going to get back to normal, but I thought that would be later toward the end of the year. Not, we almost got back to that 180 level early. Let's just say that Trump does these 15% tariffs and demand gets hit. Private credit is getting weaker and weaker and stocks start to sell off. Can that push the 10-year yield below 380? Yes. A market event like that can. We saw that in 2024, right? In 2024, jobs were running at 160,000 that year. And the market completely freaked out, thought we were going into a recession. That would be to me a positive rate story, maybe not a positive economic story, but one of the things I've talked about going into this year is what if the tariffs are totally kicked out, and there's a refund of money, and then the tax cuts and everything, all this stuff going into that would be a very healthy backdrop. But now, if you are going to do unilaterally 15% tariffs, and private credit is breaking maybe to the sense, and you get more AI headline layoffs, you could definitely get below 5.75%, or maybe if the market sells off, a rush to bonds. But it would to me, there'd be limits to the downside unless the Federal Reserve altogether, right? I mean, we have a lot of hawks still on the Federal Reserve Board who keep on saying the labor market is fine. Austin Goolsbee yesterday came out and said, listen, the labor market's fine. It's stable, right? So something like that can maybe be a positive wild card in terms of rates maybe going lower than what I thought it could be the case.
Listen, if we're going to be wrong on one side, let's have it go lower than what the forecast was, right? It's always really tricky because usually that means that like the different parts of the economy are not doing well, right? I mean, if it's labor over inflation, it might mean that you're heading into a recession, or you are seeing a lot of layoffs, which no one wants that. On the other hand, like whatever the economic reality is, let's have the one that is going to be really helpful to housing.
So in this context, we've been below 380 two other times. Of course, 2024, there were so many negative revisions. Jobs were missing estimates. In 2023, the Silicon Valley banking crisis, the dollar was super strong. London was going to lose its pension. Remember when London was going to lose its pension funds? They couldn't even open the market. And when the dollar gets too strong, 110, 115, all hell breaks out of the world. It's complete chaos. But in this case, jobless claims data is still very low. I know a lot of people say, well, it's a gig economy. No, listen, the history of U.S. economics, man, when claims break, industrial production falls, private investment falls, consumption falls, all these things run together. And we just don't see that in the data yet. But for this year, if you get a stock market sell-off and kind of negative headlines, you could see money flowing into it. It's just that to me, it's just really hard for the Fed. If Fed is running a neutral policy and the market's already pricing a lot of that in, it's really hard to break under 380, as we've seen for the last few years, unless there's some, market-driven event or a theme of the economy breaking. If the economy's breaking, then you could easily go below that. But for now, I think that would be on the rate side, a positive rate story going lower.
So I do have a question. Like, I know that you have said that, the people's expectations that like, oh, once Warsh is in, which by the way, still hasn't been confirmed because we need, the Federal Reserve is being investigated by the DOJ. You've had senators say they're not going to confirm Warsh until that investigation is over. You've had Trump double down. We now hear that there are, conversations going on where the Federal Reserve has asked the Supreme Court to intervene. Anyway, lots of things going on there. So, but say we get Warsh in, you've said like that doesn't mean automatic lower rates. But my question to you is, given all the stuff that's going on with the change in that leadership, is it still going to be the Fed's going to look at labor over inflation?
Yes. I mean, Kevin Warsh is going to be more dovish than Powell, like by a lot at the meeting. So, but they're talking about doing stuff with the balance sheets and stuff like this that a lot of market people are like, that's not, even the Federal Reserve governors have said, I don't know what you guys are talking about. That's not really feasible. We don't want to create banking stress or anything like that. But hypothetically speaking, let's just say jobless claims does start to perk up higher and higher. It doesn't really matter what the Federal Reserve, the bond market's going to get ahead of the Federal Reserve, and then the Federal Reserve has to come after. So the question is the Beth Hammocks of the world, the Lori Logans, the Austin Goolsbees, who say the labor market is fine, it's stable, there's nothing wrong. Inflation is a concern, even Austin said, I see a path for maybe 2 more rate cuts. The market is really just like toward the bottom of the range. But if jobless claims break, the bond market does all the heavy lifting for the Federal Reserve first. The Fed plays catch up. That's just the institution can't be as fluid as the 10-year yield is. So Warsh is definitely going to be more dovish, of course, and everything kind of just moves off of that. But the closer you get to the midterms, Trump really needs to get his people in to try to push this. As you can see, it is a full court blitz by the White House when it says mortgage rates are under 6% or mortgage rates the lowest in years. So we go back to our Trinity discussion on November 7th, 2024. We said three things that the White House wants: lower rates, lower energy prices, and a lower dollar. They kind of have that, right now. They would probably like rates a little bit lower, but energy prices were lower. And the reason for that thinking is that everyone buys gas every week, right? That's something that if you see lower energy prices in your mind, you think, hey, listen, energy prices. Millions and millions of people buy and sell homes and move, and life is formed around the housing market. So lower mortgage rates, in people's mind, that's, and if you really want to like export stuff, you need a lower dollar, right? You can't have the dollar too strong. So I think they have everything they want. I know Trump always talks about, well, we need to lower rates to lower the interest payment on that's not what the Federal Reserve does. They don't ever look at that, nor this has been talked about a lot the last 2 years. It's not in their mandate. They do not care, nor it is not anything that they, like the old Kevin Warsh before he became Kevin Warsh 2.0, Trump's boy, would have said, there's no way we need to lower rates to lower the interest payments. The government needs to balance their budget, by themselves. But here we are, and that would be the case for, some type of economic event, stock market, but we're kind of toward the end or the bottom end of this forecast range for 2026.
So you've talked about some wild cards too. Is there any other wild cards that you see that could lower rates?
Those are really it. I mean, those are, or hypothetically, let's just say, because there's all this talk about Iran and everything. Let's just say there's maybe a bigger form of escalation in the Middle East that draws other partners into this fiasco. They have flight to safety, in that context. And obviously, inflation is not doing anything because with that PPI inflation report, barely even smidged the 10-year yield. So that's another hypothetical that, if you wanted to think of something. But those are for like what could go lower for rates. Now the question is, what's the wild card to send rates up higher?
Absolutely. That was my next question. So you jumped ahead. So tell me what that looks like.
So the wild card is, and it becomes a little bit more tricky now because Trump wants to do these 15% tariffs, and there's no, it's funny. Everybody wants to give checks to everyone. Like there's the refunds for the tariffs, and then there's the tariff checks. As like politicians on both sides figured out, just throw money at people. If you throw money at people, people get happy. So now the refund for the tariffs going away, that was different than the refund for the checks, right? So when people say they're going to balance the budget by, they're going to use the money to bail out farmers and then give checks out to people. You can't use the same dollar like in 27 different things, okay? You don't have that much money. But I don't know. Let's just say hypothetically the tariff situation is resolved. Like they take tariffs off. And companies go, okay, you have free reign to do whatever you want, right? You don't have these ups and downs on GDP, on exporting, front loading, getting stuff or all that stuff. The tax cuts, people have more money. They're able to sound dovish. And then the labor data gets better, that can push up rates. But even with the labor data getting better early on or stabilizing, not a lot of people believe the headline reports, but that 430 level didn't break either. So, we have a very, very low, kind of a low channel rates, just like 5.99 to 6.25 out here. But to get to the upper end of the forecast, 440 to 460 on the 10-year yield and 6.5 to 6.75 on mortgage rates. The economy outperforms, the unemployment rate goes lower, wage growth starts to perk up, not head lower, and the inflation data stays sticky. Those are the things that, at least I believe, that can push rates up higher as a wild card. Is that the wild card is always the U.S. economy outperforming expectations. Now here you have all these headlines, right? AI is going to take all the jobs. Private credit market is breaking. Stocks are overvalued. There's all these things going on here. So let's say a lot of that reverses. And no matter how dovish Kevin Warsh sounds, the hawks really start pounding the table and saying, we believe we need to stay more restrictive than what people want because inflation is too sticky. So an outperforming an economy like I think the first or second article I ever wrote for HousingWire, an economy outperforming doesn't necessarily mean it's good for housing because rates tend to move up. So that would be the wild card to the upside now, because clearly right now the inflation data is not doing anything. There's just a lot of noise around the future prospects of labor with AI and credit breaking, stuff like that.
Okay, so what if you had to place a bet? What are the wild cards that you believe in more? Do you think we have more potential to go lower or more to go higher?
I'm kind of just sticking in my range, okay. But if you had to there's probably a better chance for the stock market to have a pullback if there's more negative headlines, and that could be a flight to quality, and that, in a sense, maybe get the 10-year yield below 380 like we saw in 2024. That has a higher shot right now just because we're not that far off, and market sentiment is very sketchy right now. So if I had to choose between the two right now, that's that. Just because if Trump doing 15% unilateral tariffs was not part of the equation this year, right? That wasn't what, I was thinking that maybe they get some clarity on tariffs and move on. So it would be something like that, to that nature. But I always like to stick at my channels just because history says when you find a normal channel tied to Fed policy, it usually stays in there unless you have some crazy event. So all I got to say is, talk about finally having somewhat of a first world problem. Lower rates, spreads better, volatility is compressed. Everyone's talking about, lower rates is a good thing. Going into midterms, they probably want that to continue. And we kind of take it to that. But you never want rates to go lower because the economy is breaking out there. But we've had the 10-year yield now go below 4% a few times without the U.S. going into a recession. So my little joke, I could do AI stuff now with that picture. I survived the 4% 10-year. I've got people partying behind me and we all survived. You can have the 10-year yield fall and not have a recession in the U.S.
Yeah, no, I think the whole reason we're having this discussion is just sort of the interesting place where we are with inflation and then the what that did to mortgage rates.
Yeah, there's a lot of scratching heads, just not just today, but the last few days. Not a lot of people were anticipating the 10-year yield to be under 4% because the labor data had improved. It wasn't great, but it had improved. Inflation had picked up on the PCE and PPI inflation today, and the 10-year yield just broke through. And again, so much of emotions and things driven by the markets are these headlines. And I think the AI disinflation theme and also, private credit getting weaker is pushing some money into safety. And we'll see. We're still I haven't brought Hodor out, getting ready to defend the key line. I always like to protect my edges up top and on the bottom. So we're getting closer to that than the top. And we'll kind of take it from there. But hey, listen, we'll take it. The housing market will take it. Stability in rates on multi-year lows, and better spreads. You couldn't ask. And traditionally, at this point of the cycle, these do occur. But you're going to have no more Powell, no more hawkish Powell. You're going to have a more dovish talking Fed. It'll be interesting to see the fight between the hawks and the doves going out for the rest of the year once Warsh is in. That's going to be some great popcorn, man. But
So
Yeah, I
you
mean,
think that at some point Trump will just be like, fine, shut the investigation down to get Warshin?
I don't think he would go through all that to have Powell just stay as the Fed chairman the whole time, you know. So, but again, I believe what's really going on is not so much an investigation. They want assurance from Powell that he's not going to stay as Fed governor, which he can do. He can still stay on the Federal Reserve Board. And I think this is all about that. I don't think this is about the investigation. I think they just don't trust that he'll leave. And maybe that happens in the background that nobody knows about. But, you know, I'm pretty sure he wants to get out of this thing. Go, oh, why do you want to sit here and deal with all this drama now? You know, go have a beer, go watch some Grateful Dead concerts, you know, spend some time with your family, man. Let everyone else deal with the craziness now.
Well, of course, we're doing this on Friday. We never know what's going to happen Friday night, Saturday, Sunday, but we will check back with you again next week. Logan, thank you so much.
Madam President, paper, rock, scissors once again won, right? This was the day.
I really like this new regime that you're calling me Madam
President. Yeah, you upgraded yourself to Madam President. So hey, listen, you're my boss. My boss said, call me Madam President, and I'm just doing it.
I love it. All right. Well, thank you so much.
Bye.
Talk to you soon.